So the first thing we have to do, just as in all questions, is to determine our group structure. So we've got our parent company, which is Bravado, and here I'll be using my extra 15 minutes to organise our group structure. So in terms of message, we own 80% of message. In terms of mixed, it's 6 plus 64. And then in terms of clarity, it's 10 plus 15. So clarity is an associate because at the SFP date, we have a 25% stake. So we've now got a feeling for what we're dealing with. Therefore, we're going to consolidate all three companies. So we're going to work our way through the question line by line. So we take PPE. And we have an initial figure of 656. Next, we've got the investment in message. So I'm going to put the cost of the investment per the SFP. We've got figures of 300 and 133. As far as our associate is concerned, we measure the associate at cost plus share of net assets since acquisition. So I'm going to go pop down to working number 6. Cost per the statement of financial position is 20. Taking the information from the question. And then finally we've got our equity investments. 51 plus 6 is 57, plus 5 gives us a figure of 62. For inventories, our draft figures are 263. For receivables, 168. And for cash, it's 210. Share capital is 520. We've then got the share capital of our investments. So we're going to take that share capital, 220 for message, 100 for mixed. We then have retained earnings. The first retained earnings figure that we see is for the parent. So you take 100% of Bravado's, which is 240. And we then go to our net assets working. Retained earnings for message is 150 at the SFP date, and for mixed it's 80. Other components of equity, we might as well put them in for our subsidiaries, figures of 4 and 7. And we've got other components of equity for the parent. So the 240 was retained earnings. Other components of equity for the parent is 17. If we come to non-current liabilities, We've got long-term borrowings, so add those together, 140. I've missed off deferred tax. Easy to do. That's why it's best to write on every second or third line. Deferred tax comes to 37. We've got trade payables 205 and current tax 92. Let's now look at the additional information. On the 1st of June, Bravado acquired 80% of Message. The purchase consideration was cash of 300 million. The fair value of the net assets was 400 million. So we're going to say here, fair value 400. Including any deferred tax liability. The owners of Message had to dispose of the entity for tax purposes and therefore sold the entity on the first company to bid for it. Now, what he's doing here, he's setting us up for a potential negative goodwill figure. Because normally we would say negative goodwill is relatively rare. An independent valuer has stated that the fair value of the NCI in Message was 86. So we go down to our goodwill calculation. Fair value of NCI was 86. And we go to our NCI calculation. And there is always a case these days, especially if there's a partial disposal, for having a separate NCI for each company. You can gamble on just using a single one. Fair value at acquisition 86. Bravado does not wish to measure the NCI on the proportionate interest, but to use the full goodwill method, so that's what we're doing. The retained earnings of Message were 136, so we go up 136, and OCE was 4. The excess of the fair value of the net assets is due to an increase in the value of non-depreciable land. So our fair value adjustment works out as 40. So what we're going to do is we're going to effectively credit the reserves of Message and debit. Oops, for some reason I seem to have missed off PPE. Oh, there it is, PPE plus 40 from working number 2. So that's note A dealt with. Note B is our step acquisition. On the 1st of June we acquired 6% of Mixed. We've treated this as an investment in equity instruments at fair value. So what will be happening here is at the end of each year the parent company will be revaluing the investment in Mixed. There were no changes in the fair value of Mixed in the year to the 31st of May 20X9. On the 1st of June X8, Bravado acquired a further 64% of the ordinary shares of Mixed and gained control of the company. So the original cost of the shares was 10. But what the company must have done, oh, here it is, it's in the third or the fourth paragraph down. At the 1st of June X8, the fair value of the equity instrument in Mixed before the business combination was 15 million. Now just notice, if you add 10 and 118, that gives us that figure of 128, but compare that to the figure in the statement of financial position of the parent company, where we've got 133. So normally I would say, well, you would revalue the assets if they were being held at cost. But if they've already been revalued by the parent, no further action is required. So we've got the figure of 133, which is correct. Under the terms of the purchase agreement, Bravado is required to pay the former shareholders 30% of the profits of Mixed on the 31st of May 20Y0 for each of the financial years 31st of May X9 and 31st of May Y0. This is what we call contingent consideration. So we go to the goodwill calculation, contingent consideration, and what's it going to be? The fair value of this arrangement was measured at 12 million. So what I'm going to do is I'm going to add 12 million onto the cost of the investment, and I'm going to add 12 million onto liabilities. Oh, it's the wrong company. So 12 million onto the cost of Mixed, but for every debit there has to be a credit. When's this payment going to be made? This is going to be on the 31st of May 20Y0. We're at the 31st of May 20X9, so this payment is due in 12 months. This is going to be our contingent payment. And that's 12 million. The fair value of the equity instrument before the business combination was 15 million. Well, we've already revalued it up from 10 to 15 in getting from 128 to 133. So we've put through that fair value adjustment of the cost. So where do we get this figure of 133 from? It's 10 plus 118 plus the 5 million increase which the company has already put through. The fair value of the NCI is 53, so we take that fair value of the NCI of 53 like so. NCI fair value 53. The fair value of the net assets is 170. So we go to the acquisition date and we've got a figure of 170. And other components of equity and retained earnings, figures of 55 and 7. The excess of the fair value of net assets is due to an increase in the value of PPE. So I add those up, they come to 162. Therefore, our fair value adjustment is 8. It's the difference between the book value and the fair value of the net assets. Up to PPE, add on a further 8. The fair value of the PPE was provisional, pending receipt of the final value of these assets. These valuations were received on the 1st of X0 and they resulted in a further increase of 6. So we're going to add on 6 to PPE. And I'm going to say fair value 2 and add on a further 6 million to our figure of 170. And that also applies at the SFP date. No impact upon the NCI. PPE is depreciated over 7 years. So depreciation on the fair value, it's 14 is the total fair value adjustment because it's 8 plus 6. Depreciate that over 7 years. We've owned the subsidiary for 1 year. So 14 divided by 7 means we're going to reduce profits by 2 because we're going to charge extra depreciation on the fair value adjustment. And we're also going to adjust PPE by 2 as well. The tax base of the net assets of mixed was 166. We've just said that the fair value at acquisition, if we add these figures together, the fair value is 176, so let's do a deferred tax calculation. Fair value of assets of mixed is 176. The tax base is 166, which gives us a taxable temporary difference of 10. So we've got a deferred tax liability. The tax rate is 30%, multiply that by 10. We've got a deferred tax liability of 3, so I'm going to credit deferred tax with 3 and debit the profits of mixed by 3 at the same time. Very few people got that correct in the exam. Tricky adjustment. So if we go to our liabilities, deferred tax plus 3 from working, is that working 7? Yeah. And we're going to reduce the profits of mixed by 3. Deferred tax 3 from working 7. So that note is huge. There's an awful lot of adjustments to get through. We've just got to get some of them right in the exam, not all of them. Note C, we have our associate. We acquired 10% of Clarity for 8 million. At the 31st of May X8, its value was 9 million. And then we acquired a further 15% for 11. So therefore, if you add the 9 and the 11, because we're using the fair value model to measure our equity investments, that's how we get the figure of 20 million. When did Clarity become an associate? We bought the first shares in X7, but that was only 8%, so it wasn't only 10%, so it wasn't an associate at that date. When we acquired the other 15%, it became an associate. So it's from that date that you take your share of profits. So it says Clarity made profits of 10 million for the year to the 31st of May X9. So share since acquisition we've got profits of 10 million and we've got a share of 25%. We've only owned the associate for 1 year. That gives us a figure of 2.5. So our associate value is 22.5. I'm also going to take those profits of 2.5 to group reserves. Share of associate 2.5 from working 6. So we're debiting investment in associate and we're crediting group reserves with 2.5. So that's note C. Note D, simply saying that we're using the fair value model. Note E says we've got another investment, but this one is an overseas investment. And we bought it for 11 million dinars. We've had an impairment, so what we're going to have to do is to say, what's the value at the 31st of May? X8, i.e. last year's statement of financial position. It's going to be 10 million dinars and the exchange rate is 5.1. So there's $5.1 to the dinar, so the value is $51 million. The value at the 31st of May X9, it's 7 million dinars times 4.8, which is 33.6. That comes from note E. The fair value in X8 is 10 million dinars. So the original cost was 11 million, but there was an impairment in X8 which took the value down to 10 million. There's been a further impairment in X9 which has taken the value down to 7 million. So we've got an impairment of 17.4. How do we deal with that impairment? That's credit investment debit Bravado income statement. Because it's an impairment, it'll be written off in the income statement, so we're going to put that through group reserves. Sorry? Because it's an impairment rather than a revaluation. It's an impairment, isn't it? So impairments go through retained earnings. Equity investments less 17.4 working number 8. Yeah, but that would be a normal fair value adjustment. If this is due to an impairment, then the argument is that you could put it through the income statement. If you put it through OCE, you'd still pick up the marks. So that you're not going to be penalised either way. In fact, let me just quickly check the model answer, see what they've done. Let me try to be consistent with them. Right, they've put it through OCE, so I'll put it through OCE. I mean, you're right to raise that point. I was being ultra cautious. Next we come to inventories. Inventories should be valued at the lower of cost and NRV. And what we can do is we can sell the goods at the first stage of the production process or as a finished product. So if we take a look at the first stage, we've got 10,000 units at the first stage of production. The cost is 1,050. We were selling them for, sorry, we did have a cost of 1,000. We were selling them for 1,050, but we've had to reduce the selling price to 950. And we've got selling costs of $10 per unit. So therefore the NRV is 940. If we take a look at the finished goods, the cost is 1,500 and the NRV is the revised selling price less the selling costs. So we're going to adjust that by $60 a unit, and we've got 10,000 at the first stage of production and 20,000 at the second stage of production. So that's 600k and 1,200k which gives us an adjustment of 1.8 million. So credit inventories 1.8 million and debit reserves 1.8 million. So I'm going to take 1.8 million off inventories. That's from working number 9. And 1.8 million off the profits from working number 9. Finally, we've got the loan to a director. Well, a loan is a financial instrument and it should be included in receivables. So why they've included it in cash and cash equivalents, I have no idea. This is the ethical part of the question. The directors feel there's no problem with his accounting entries. There's a choice of accounting policy within international financial reporting standards. No, there isn't. It's a financial instrument. It should be included in receivables. So what I'm going to do here is I'm going to increase receivables by 1 and reduce cash by 1. What we can then do is our additions. 176 for mixed, 196 at the SFP date, so therefore there's an increase of 20. If we take a look at message, we've got figures of 400 and 414. So in terms of calculating goodwill, we take away the net assets at acquisition. So that's going to be 400 for message and 176 for mixed. So we end up with a goodwill figure of minus 14 for message and plus 21 for mixed. What do we do with negative goodwill? It is taken to the income statement and therefore retained earnings. It's not actually called negative goodwill, it's called a bargain purchase, but I think most people know it as negative goodwill. And it's credited like so. The positive goodwill is taken to the SFP. When it comes to the NCI, we're going to give them their share since acquisition. And for message, it's 20% of 14. Which is 2.8. What do we do with the other 80%? Group reserves. And for mixed, we ended up owning 70% of mixed. So that's going to be 70% and 30%, and the profits since acquisition were 20. So for the NCI, it's 30% of 20, which is 6, and 70%, which is 14 for retained earnings. Add those two figures together, and we've got an NCI total of 147.8. Oh yes, you're right. It should have been that deferred tax also affected the position. So you're absolutely right. That should have been 173, and the profits since acquisition are 23. Well spotted. That means I'm going to have to change these. So we've now got a goodwill figure of 24. I can't add up. Yeah. Right, well, we're struggling for battery life. So I've only got one plug adapter. Left the other one in the hotel. So 30% of 63, so that's going to give us 59.9. So our NCI is now 148.7. And the group's got 70% of 23, which is 16.1. So our other comprehensive income is negative 0.4. And retained earnings are 282. Now remember, don't bother to add it up. The chances are you will have made a mistake somewhere. Chances are I will have made a mistake somewhere as well. 1439.3. Our associates, remember to put that in, that's 22.5 from working number 6. Our equity investments are now 44.6. $261.2, 169 and 209. $1439.3, and that balances.